This video will guide you through how VisionWorks, our next-generation life planning software, can take your financial planning business to the highest level.
So I contend that all planning tactics are one of three C's: convert, downsize a home, sell a business, for example; create. In our industry, we focus on portfolio rates of return, but just as easily, it could be creating through a business. Many people are in their own business. And conserve, how we're spending money, etc. And then the special form of conserve is not paying the tax man more than we need to, which is, under tactics, what the tax optimization is all about. So I contend that all planning tactics will fit into one of those three C's. And which of the three C's we apply is going to depend on the five themes. So that's what we want to go through today. And the five themes are house rich, cash poor. Your net worth looks great, but you see a shortfall in your income producing assets. What we call the large latte factor. In theory, you should be able to save far more than you actually are. The net cash theme, people are running cash flow negative and they're very concerned or worried because they don't have perspective that says in the long term, things are going to be fine. Okay to spend more, which just says the picture looks great. And if you wanted to spend more, you could. It applies to people in their retirement years more than anything. And then the high net worth theme, which says, you're fine, but your core issue is going to be very large estate taxes. And for anybody in that situation, my view would be, if all we're doing is giving them that retirement comfort, you're going to be fine in retirement, we're not really bringing a value add that's going to be very earth shaking for them, because their true issue is the estate issue. So I've got a file with the five themes. Thought we'd open it up and just go through them. So once again, I'm in the theme that we call house rich, cash poor. And all it basically is saying, if we look at net worth, is you've got the big house, you've got the big cottage, you probably got an excellent cash flow, children are in private school, you're able to pay the mortgages, pay all the other expenses. But because of all of that, you're not actually saving enough money to be able to maintain that lifestyle during your retirement years. And the consequence then of that is that net worth looks great, but the income assets definitely show a shortfall. So we've got, the house rich, cash poor problem. And I would suggest to you that this is very common. And when we think then in terms of the three C's, convert, create, conserve, obviously we would always apply reduced taxes. So where there's a couple, we would optimize for taxes first. But otherwise, we have a bit of a challenge here. It may well be that suggesting to people that they're going to have to cut back on their expenses in order to save more may be either challenging for them to do or something that they're really not inclined to do. So just keeping that in mind, very often the issue for people like that is that at some point you're going to have to tap into the equity of on your house, whether that's through a reverse mortgage or a home line of credit or plain downsizing. So maybe we keep the cottage, but maybe what we end up doing at some point in time is we end up going in and selling the house, and then downsizing, let's say, to a condo. Let me make that 2030. And of course, when we sell the house, then what ends up happening is we take a sharp jump up in our income assets because we put all that money into the bank account, transfer it into the non-reg portfolio, and then needless to say, we would have to go in and do an offsetting purchase. We could either rent a place actually after that, or an offsetting purchase for a condo, for example. So then we would just go in and add the condo expense. And keep in mind that we can add it as a principal residence. And you can also include land transfer taxes to get a much more accurate idea. And again, it's a matter of course, what we would end up having to pay for it. So very often people that are in the house rich, cash poor theme are really going to likely have to liquidate assets like a house, downsize and take the capital out. That's where they're building their wealth. They're building it in their real estate. And so tapping into that is, very often going to be a necessity. So that's the house rich, cash poor theme. What I want to do is, I'm just going to reset this. What I want to do is then now look at the next theme, which is the large latte factor theme. And again, I think this is another theme that's very commonplace in today's society. Now, normally, of course, the main bank account would be running along at zero because we would be transferring any excess cash into the main bank account. But I've intentionally deselected that feature because I wanted to be able to show the buildup of the excess cash. So people come to us, they say, this is our career income, a couple of $100,000, pretty straightforward. Most people know what their year in and year out sources will be, their job, maybe rental property income, maybe dividends from a corporation, that kind of thing. So they give us their sources and they're pretty comfortable with it. They give us their uses, but what we see when we net out sources and uses is that in theory, these people should be able to save a great deal of money. Well, the problem is if we look at their income assets and their non-reg portfolio, what we find is, assuming, they're maximizing TFSAs and RSPs, but what we find when we look at their non-reg portfolio is there's nothing in it. Well, if habitually they were running excess cash, then how come it's not accumulating in a non-reg portfolio? Oh, you should have saved X, you should have a portfolio of whatever, and where is the money? So this is the theoretical savings, and it's not usually the sources. They're usually fairly straightforward. It's people underestimating their uses. I was doing a coaching call yesterday. The sources were very clear. The uses and the theoretical savings were about $60,000 a year throughout this person's working career. And yet the advisor said she saves nothing. So it was a clear case of underestimating the expenses. And we call it the large latte factor. It's a term coined by David Bach, actually, in the US. And I love it because we all have a latte factor. We all spend money and don't know where it goes. It's not a question of that. The question is, what size is our latte factor? And what we're seeing here is the latte factor is running, $30,000 to $40,000 to $60,000, $70,000 a year. Where's that money going? So in theory, if we're saving it, if we've got the uses right, then what's happening, and this is why I just left it in the main bank account so we could see it more clearly. What's happening is that main bank account should be growing in value, ultimately, of course, being transferred into the non-reg portfolio. But we can clearly see that happening, this excess cash. And that's exactly, if we look at total income assets, what's driving up our total income assets to say we're going to accumulate enough. Well, what we know is they have a large latte factor. They don't know where that money's going, but it's not sticking. We know that because we can look at the non-reg and see it. So in this case, what we can do is go to entries, joint tab, lifestyle, general expenses, and say to people, well, if you're not keeping it, it means you're spending it. The question is, what's the impact of that? So all we need to do is say, we know you're not keeping it, you're spending it, so let's turn on spend excess cash. We click the OK button, and then when we come back and we have a look, what does it look like? Well, we're not getting that savings anymore. We're spending the money. Now we're back to the picture that looks exactly like house rich, cash poor. So again, people will tell us their income, usually pretty reliable. They'll tell us their expenses. We look at the two. We see, in theory at least, a whole lot of savings. But we know in fact that we don't have it. The money's being spent. So all we need to do is turn on spend excess cash, and then we help inform the client. And if we don't start to capture this, for your future, then this is what the picture is going to look like. So it's a fairly powerful way of communicating that message, and pretty simple to do it. So let's go to net cash. Net cash is a situation, again, I've left that spend excess cash, the transfer of money out of the bank account. I've left that turned off just so we can see this bank account. So, and I want you to notice that here it's going down and then it's going back up. Income assets staying flat, going back up. Well, this is a situation that arises where, the people are running negative cash flow. They're getting all upset about it. And very often this is happening because of a particular expense. And the expense that I put in was just the education expense for Bill Jr. So you can see it may run a number of years. I've only got 2, but it could be, a few years. And because they don't have enough cash in the bank or in the RESP to finance that, what's ending up happening is that they're running cash flow negative. And so, they're running up a line of credit or, borrowing against their house, whatever they're doing. And they're getting very upset. The world is falling apart, and they're getting upset because they don't have perspective. And what we're able to do is say, well, that's fine, but that's a very short-term situation, and it's for a very specific reason. And once you get past that short-term issue, then eventually, you're back to regular savings and the growth of your income assets, and the total income assets will be, ultimately will be fine. So that's number 3. Number 4 is okay to spend more. And this is predominantly, let's go to total. This is predominantly the case for people who are retired. So you can see up here, I've made Bill and Sue 76 and 71. And because people are afraid of running out of money, very often they're not spending what they could spend, quite reasonably. And that doesn't mean spending on themselves. It could be contributing to grandchildren's RESPs, for instance. So once we help people understand you're going to be fine, and keep in mind that we're showing actual dollars here, and all we have to do is click the today's dollar button. So even in today's dollars, you're going to leave several $100,000. People, again, just don't have perspective. So once we help them understand that, that's when they're going to say, oh, well, does that mean, and then, come up with whatever it is they've come up with. So again, let's go to that vacation expense. What would happen if instead of spending $10,000 on our vacation until we're 85 and 80, what would happen if we spent, 15,000 or whatever their number might be? So we can, simply make the adjustment and then click the save button. And once again, show the before and after. And you can see, even though we've increased the spending on vacations by 50%, the difference in their lives is relatively nominal. I can recall with one of our clients, the very first plan he did was with his father, who used to go to Arizona for several weeks in the winter, sort of February, March. And he quit going because he felt he couldn't afford it. And it was only 6 weeks, I think it was, and not much. It was like $5,000, really not very much at all, $30,000. Well, the advisor put it all in, showed the result, and the father had investable capital of about $750,000. The $30,000 was barely visible on the graph. So, we just simply said, you can afford to do this if you want to. But with this lack of perspective or the impact of a change, people often don't do things just because they would like to, but they don't, they just don't know what they can do. So it gets very easy then to help show them that impact. So that's, again, okay to spend more, not necessarily on themselves, could be on grandchildren, but it's very common theme for people who are retired. It's also very related often with the high net worth theme. And the high net worth theme, again, says, your income assets are going to be fine. That's not an issue. The issue for you is because you have wealth, keeping the cottage in the family, or you've got rental properties or whatever it might be, the issue for you is going to be an estate issue. So we can see in this particular case that we've got lots and lots of assets. Some are fixed, some are liquid. And even when we have liquid assets, the problem is we have a big tax hit at death between income taxes and probate fees, so that we end up with a residue for distribution that's negative. And that means we would be forced to sell. We've used up all our liquid assets, so we would be forced to sell other assets, be they rental properties or whatever they might be. So again, doing the plan that says you're going to be fine in retirement, you can afford to do everything you want to, you could even spend more if you wanted to, that's very comforting. But I think most people who are relatively wealthy already know that, and they're not really getting the value add. The value add comes when we're able to show them the effect on the estate of just how much they're going to pay in taxes, et cetera. And then that's when they may say, let's put, we've got this portfolio, we can afford to buy insurance, or maybe what we'll do is we'll set up what's often called an insured retirement plan. So we can, take some of that portfolio money or excess cash flow and move it into a paid up insurance policy that will, take care of the tax man. So those are the 5 main themes. And I would contend, let's go back actually to our 3 C's and 5 plan themes. I would contend that as soon as you are comfortable with the inputs and you think they're solid, you're going to be able to look at the output between net worth and income assets most of the time. And you're going to be able to say clearly house rich, cash poor, or where you have this theoretical excess cash, which is causing a rapid buildup in the income assets. You're going to be able to look at that and say, are you really saving that? If so, where's that large non-reg portfolio that you should have? And you're likely uncovering that they have a very large latte factor, and we can illustrate that to clients just by turning on spend excess cash. I was only buffaloed once with this, where the couple looking forward, when a coaching call, the couple looking forward should have had, or were showing excess cash flow, should have had a large portfolio. And it took a number of questions with the advisor before he said, oh, well, they do save a lot. They are very cautious spenders. But what they did last year was they went out and took up all the savings and used it as a down payment for a house. So going forward, it was an accurate picture. What had happened was there was a special event in the year before that used up all those savings. So you just have to be a little careful of that. That might be the case. So, just be aware that it may not be large latte factor, but it would have been a very recent event, like literally in the preceding year, where they did use that non-reg portfolio. That may be kind of your question, Grant, in a way. Net cash flow, again, they're running cash flow negative. They're very concerned about it. Typically, it's from a specific reason, educating children, whatever it might be, and everything will work itself out in time. Okay to spend more. I don't have a graph for that, but it's essentially, the income assets look great, and you could be, spend more if you wished, including on not just on yourself. And then, of course, the high net worth theme is you're going to be fine. But the real value add for these people, of course, is uncovering their estate issue that just says you're going to pay a fortune in taxes and probate fees. And, how do you feel about that? Or because you're going to pay so much, if you have your investments in real estate, for instance, then you're not going to have the liquidity with which to pay the tax man, meaning you'll have to sell rental properties, for instance, to pay the tax man. And, may not be the ideal time to do that. So, maybe some insurance is in order. So those are the 5 themes. If the inputs are reasonably solid, you should start to see these themes jumping out at you. And as soon as they do, that's going to give you focus as to the 3 C's that should be applied. Obviously, all themes, you're going to apply the tax optimization. But then, should we be converting wealth? Are we going to have to build wealth or conserving wealth? Latte factor, where's all that money going? We need to capture it.
Book a demo. We'd be happy to show you more of VisionWorks' incredible features.